Hello, I'm Jay Martha, Global Head of Housing for Nuveen Real Estate. I'm going to talk to you today a little bit about the MIMI's report, Middle Income and Millennials, and the household demand for apartments in the US. In 2019, we studied the age cohorts of income segments of renters' households across the US. Since then, the country has endured an unexpected recession caused by a global pandemic, which disrupted the economy, but ultimately reinforced underlying trends. Despite recent market volatility, the update to our original analysis continues to demonstrate that MIMIs, or millennials and middle-income households, will sustain demand for US apartments going forward. We define middle-income households as those earning between 80% and 120% of median income, or approximately $45,000 and $75,000 a year. As you can see in Figure 1, these households comprise between 15% and 25% of each age cohort, with the largest concentration of middle-income households in the 25 to 34 age range. Middle-income households often rent out of necessity, which creates consistent demand for apartments that target middle-income renter segment. As you can also see in Figure 2, the millennial generation spans approximately 18 years. We therefore further divide the generation into two groups: older millennials, those between the ages of 34 and 40, and younger millennials, those between the ages of 23 and 33. Our analysis indicates that older millennials, greatly influenced by the global financial crisis and in search of employment, migrated to several of the large core gateway markets in the US. This created significant demand for apartments. However, those older millennials are now roughly 34 to 40 years old and are largely married, started families, and the majority are likely to buy homes in the next few years. We believe this will create an investment opportunity in the overbuilt luxury and Class A apartment market segments, particularly in large, expensive, major gateway cities. In Figure 3, you can see these gateway markets include San Francisco and Los Angeles, Seattle and San Diego, San Jose, Denver, Boston, and New York. We refer to these 8 metropolitan areas as flight to suburb metros. Class A and luxury apartment buying opportunities could arise as pricing becomes dislocated due to more pessimistic rental growth expectations, concerns about oversupply, and a flight to value offered in many of these secondary and tertiary markets. The younger millennials, roughly 20 to 33 years old, are in a very different stage of life compared to the older millennials. In the coming decade, younger millennials could reshape apartment markets in cities such as Charleston, South Carolina, and Orlando, Florida, if, as we anticipate, these cities experience an influx of millennials looking for high-quality jobs and a lower cost of living. Younger millennials more recently attended college and are looking for their first job or are upgrading to a second job. In the early stages of their careers, they are likely to be attracted to more affordable markets with strong job prospects, particularly in tech. In Figure 5, we have identified a group of established but affordable tech hubs. In these markets, tech jobs represent a sizable component of the local economies, over 7% on average, and forward-looking prospects for tech employment growth are favorable. In emerging wildcard cities we've identified, the share of tech employment is marginally below the national average of 4.7. However, growth in tech employment has been strong in recent years and is expected to continue to be well above average pace going forward. Higher education, healthcare, banking, and corporate headquarters tend to be the driving forces behind these metros being identified as tech hubs. Turning our focus to household incomes, millennials tend to earn the US median income or less, making them the rentership generation. Relative to other age cohorts, a higher percentage of those aged 25 to 34 earn between $45,000 and $175,000 annually. This will continue to drive demand for apartments going forward. Aside from earning middle-income salaries, several key factors contribute to millennials' propensity to rent, including declining home affordability, record student home loan debt, stricter lending requirements, and delayed decisions to marry and start families. Additionally, a recent study indicates that almost 22% of millennials are living at home with their parents. This is up 9 percentage points since 2005. This is particularly evident in flight to suburb markets like New York and Los Angeles, where over 30% of millennials are living with their parents. This could also contribute to the luxury and Class A apartment dislocation we expect. Finally, middle-income households represent a stable and sustainable long-term source of demand for apartments. Following the global pandemic, a majority of millennials will be more cost-conscious, at least initially, and will avoid more recently built higher-end rental units, creating increased demand for value rental housing in Class A and well-located Class B apartments. We believe exciting and emerging or redeveloping neighborhoods in these metros could prove particularly attractive for younger millennials over the next several years. Affordability is a key differentiator among the markets we've identified. The apartment markets in each of these metros will undoubtedly benefit from the growth in tech and influx of younger millennials. Many of the next millennial magnets are less urban in nature, and more multifamily demand will likely be concentrated in attractive, highly amenitized suburban locations. Apartments that target the middle-income household have outperformed more expensive Class A apartments for the past 5 years, and we expect that trend will continue going forward. I appreciate you taking the time to view this video. I hope you have an opportunity to review Nuveen Real Estate's full report on investing in the Mimis. Thank you.